Welcome back. All eyes today are, of course, on the Fed's rate decision announcement this afternoon. The focus is on the statement's language and the so-called dot plot forecast and whether either will indicate subtly that rate cuts are coming in 2024. For more on this, we're joined now by Blake Gwinn. He's head of U.S. rate strategy at RBC Capital Markets. Blake, thanks a lot for joining us on a story, of course, that is front and center in investor minds today. You do not think the Fed is going to signal in any kind of significant way that rate cuts are coming in 2024. Explain why.
Well, I really don't. And I think, you kind of mentioned it in the intro there, but it could come in two forms. You could either see it in the dots or you could see Powell mention it in the press conference. I think in the dots, if we look back to September when they released their last set of projections, those dots basically implied a 50 basis points of cuts in 2024. So I think there's a focus on whether those are going to stay at 50 basis points of cuts or whether they're going to start to imply 75. I'm actually of the view that those are going to stay at 50. I think there's a couple reasons for that. I think if you had asked me before the NFP release last week, I might have leaned a bit more towards 75. But I think the fact that we have a strong jobs print, a relatively strong jobs print, that is going to help the Fed feel a little bit more confident. I think also, if you think back on those September dots, 12 of the people who submitted those dots had a higher terminal rate because a lot of them were still building in another hike in 2023. But now that we know that that hike is not going to happen, they're basically using a lower terminal rate in their economic models now than they were back in September. So that does take, I think, a little bit of the pressure to add cuts in the back half of 24 into their forecasts. And the last I would say is signaling. I don't generally think that the Fed uses these dots to as kind of a communication tool. I really do think it's more of an academic exercise, that these are kind of forecasts that they put together using their models. But there is always a bit of a thought that they could kind of engineer those dots to show something that they want. And I think they're probably a little bit hesitant to signal more cuts by moving that to 75. As far as Powell, he had a chance, I think, to open the door to cuts when he spoke before the blackout period. We didn't see him do that, and I don't expect him to open that door now in this press conference if he didn't before the blackout period.
One Fed governor who did seem to open the door fairly significantly was Christopher Waller. In late November, I believe, made some comments, public comments, that were eagerly interpreted by investors as an indication that the Fed is willing to dial down rates. How do we reconcile the public comments of Christopher Waller with the subsequent public comments of Jerome Powell?
Well, one thing, and I think this is always kind of a subtle point, but when he did make those comments, the ones that people really focused on as far as, potentially cutting earlier if inflation continues to come down, those were in the context of a Q&A rather than prepared statements. I know that doesn't always matter, but, I think if it's a more deliberate signaling, you would see that show up in prepared remarks. But I think he was kind of asked on the spot about it. And look, they're obviously thinking about the possibility that if inflation comes down, they could cut. I mean, it'd be kind of silly to think that that's not a possibility they're considering. But, he was asked a question and kind of opened the door to some of that private thinking that maybe is going on, behind closed doors at the Fed. So I think markets really reacted to that. But overall, I don't think that this was a coordinated strategic effort to start introducing this idea of earlier cuts into the market. I think that's part of the reason we did not see Powell follow up on that when he spoke shortly after that, just ahead of the blackout before this FOMC period. And I think very similarly, when he goes out there later today, I think his main goal is going to be to make sure he doesn't fall into any of these kind of dovish traps by accidentally getting hung up on a Q&A. In the Q&A section when somebody asks him about these. He's going to be very careful, I think, to control his language in a way that doesn't suggest that cuts are coming earlier.
So you don't think the Fed is going to indicate even subtly that rates are coming? What is RBC's call on what, in fact, will happen with U.S. rates during 2024?
So we do think rates will continue to move lower in 2024. We have the economy slowing. It's not a hard landing, but we do have this kind of soft-ish landing where consumption slows, growth slows, particularly in the first half. The unemployment rate starts to rise fairly gradually. And we do have inflation continuing to move closer to target, even though it doesn't get all the way into the Fed's target range by the end of the year. This kind of economic backdrop, I think, with slowing in the economy, and allowing the Fed to start cutting, I think, around the middle of next year. Both of those things will combine to continue to pull rates lower. So we have 10-year yield ending next year somewhere around 3.95.
The annual pace of inflation, as reported yesterday, was 3.1%. You believe that inflation, the path of inflation is on the right track. RBC believes that inflation is headed to 2.0.
It is headed there eventually. It may take quite a long while. We do not have it getting, so we look at core CPI. We do not have core CPI getting to 2% by the end of next year, but we do have it on a steady path downward. I think when you get into early next year, we expect owner's equivalent rent. That's the shelter component of CPI. That will start to provide a drag. If you look at how OER works, there's typically a drag to what has happened in housing markets, kind of 22 months ago. So if we kind of look at what happened 22 months ago in housing markets, we think you're kind of set up for this probably 14-month drag on CPI prints from OER, and that is essentially the biggest component of CPI. So I think it'll be very difficult, even if we see other pockets of inflation picking back up in certain categories. Fighting against this headwind that is coming from owner's equivalent rent will be very difficult. So I think it'll be very tough to disrupt that downward trend, even if it doesn't move maybe quite as fast as the Fed would like. We do see it continuing throughout the year.
Blake.